All right, so what we have here at Rocket Scooter is a series of 12 different indicators that are all designed to be leading indicators. We've thrown technical analysis out. We've created positional risk analysis, and all of these things that you see that I'm about to show you in this video are going to completely change how you view trading analysis. No more technical indicators, no more delayed chart patterns, nothing. So first thing today, I'm going to go over this very quickly. Resilience is one indicator that you will learn here that points at a possible breakout before it happens. This one happened 22 minutes before the move. Monthly hedge pressure is something our algorithm gives you. And you can see for the SPY that when we got the signal that SPY, this yellow line, wanted to break through the yellow line, we got it. The second signal came about 45 minutes in advance, where this leading indicator on the S&P shows that being below zero, that the white was also going to be resistance, which is exactly what you saw. So all day long after we broke through this yellow, white is resistance, and it came back down to fill the open, just like we said it would right here before your very eyes. Now I'm looking at leading indicators as one of the things that we do. What does all this stuff mean? Well, I'm going to show you some of it, and we're going to start very much right here at the beginning. And I'm going to go through exactly what playbook is, what walls are, what hedge pressures are, and how I can look at these two lines to see how SPY is likely to move before the move happens, and know that that resistance is there before it happens. And I can actually plan my trade and trade my plan without having to rely on charts or technical indicators to get me by. Okay, so starting right at the top, I have one stock I was going to look at, LLY. We're going to explain very quickly what hedge pressure and walls are, and this is going to be a nice little lesson on a big portion of what our algorithm actually does. So what technical analysis traditionally looks at is historic price and historic volume, and tries to make predictions about the future based on just the shape of price movement. Now, as an engineer, so my background is in chemical engineering, that entire concept sounds silly to me. That the past can predict human future behavior. And I'm sure you're here looking at this video because you've kind of realized that that doesn't necessarily work. And markets are random and hard to predict, and you couldn't be further from the truth. So what we look for are real exploits in the market that aren't looking at price and volume history to predict what's going on in the future. As a matter of fact, I look at a few numbers that we derive from our algorithm, and I don't even need to look at a chart when I can make my trade plan. One of the fun things we do here in the live stream every morning, it's called Lightning Round. People give me 20 stocks. I will look at just a few numbers and draw where I think the market's going to go without even ever looking at the chart, historical chart, nothing. It's a brand new way to trade, and we invite everybody here to check it out, to look at that. So the first thing that we have is something called walls. And the very simple concept is, instead of looking at the historic price action, it's looking at where people are positioned. It's a very cool concept that actually shows you where the real bull and bear side of the market is. And I'm going to draw it for you right now. So in LLY, for instance, you can see that there's like the straight distribution of just these red boxes that say call. These are actually real bulls in LLY. These are real bears in LLY. These are actual positions. So whatever made them buy or sell there, whether it's fundamentals or technicals or whatever, this is one step above everything, which is the sum of everybody's decisions, the sum of everyone's homework. So for instance, where LLY today opens right here where I just circled on the chart, it actually opened on the bull side of the market, and that's what that little B stands for. It opened above all these bull positions. So these are derived from options, and all of our information comes from the options world. We have professional option speed that comes through, make an analysis on that information. Our algorithm extracts where market maker positions are, which is exactly what this is, and the distribution of market maker risk to find the balance point of the market, the bull point of the market, and the bear point of the market. So the algorithm will give you 3 data points right out the door when the market opens, which is the great thing. You have the signal before anything happens, which is kind of the goal of a trader, to not have to always chase what's going on and try to make some kind of plan before it happens so that you can behave in a repeatable fashion with your own trading style. So an example, these 3 letters, market opens on the bull side of market maker positions. So there is a real trader here that's a bull. They bought the market against no seller, the dealers had to sell to them, and the dealers offset their position with an option. So we find that whole relationship. We look for those options. We extract where the real bulls are in their positions. So LLY opens on the bull side. Perfect. So the next step is what these hedge pressure numbers are. And if you look at where all these options are distributed, it's telling me where the real bull and bear side of the market is. Well, if people buy options from option sellers, then the option sellers are at risk if these options go in the money. For example, LLY, these calls are in the money. So whoever sold these calls needs to actually also long LLY stock to acquire the shares in case these calls get exercised upon, or they'll long at the rate of delta to offset their risk. Either way, there's an additional longing pressure above this exact number that, again, is calculated at 9:30 in the morning, right when the market opens, to let you know that above 315, you're getting a little bit of an influx of long orders that are outpacing the short orders just on the hedging and acquiring of shares because somebody sold those options. They're not necessarily bulls that are longing. They're algorithms that are longing to offset the risk of selling those options. The combination of being on the bull side of the market and the long side of hedging, or what those two letters mean, and you see it's a very strong bull signal that Lily opens right out the door and hits 315 and then just rallies. This third letter is a neat thing. Probably won't cover it too much in this video, but it shows the relationship between short-term hedging and long-term hedging, as everything we exploit here is repeatable algorithmic hedging or positional risk distribution. We look at things that are just right in front of your face, and options always have an expiration date in the future. So all of this is future looking because we take into account all the properties of Black-Scholes and things that go into calculating the price of options. So with that information, we try to look into the future, let the options tell the tale of where everybody's risk is and desire to be bullish and algorithmic desire to long and short the market. When I look at these three letters together, this B, L, and U, now I have the idea that the market is, that the stock opens on the bull side with a little bit of extra pressure from the long side of hedging, and that the up just means that the shorter term and the longer term, you have a little bit of extra upward boost because you have shorter term hedging pushing the market a little higher, or a little faster than longer term hedging. In this particular example, they're at the same place. But usually what it means is that you'll have this hedge pressure above monthly. When the price opens above both of them, then it's also considered upward pressure. So when I put the three of them together, we give you a nice little playbook, which is a little series of flashcards, which just show you, we call it a liquidity map, which is where buyers and sellers are known to be. Remember, these are bulls. Anything above 315 is algorithmic longing. So there's an influx of buyers above 315 because you're in the bull side of the market and long side of hedging. And you see that influx of buyers just pushing the market higher. Liquidity map shows you that the market is pushing from either of those areas. This is the open price, it wants to push up, or the bounce against blue, it wants to push up, or the bounce against yellow, it wants to push up. So the idea is that this kind of helps you look at the market and say, well, it's moving up on all these factors together. Well, would I want to short this? Not really, right? Because there's no evidence that anybody's shorting. So why would I get on the wrong side of the market to bet that everyone on Wall Street changes their mind for no reason? You know, I wouldn't, right? So if, for example, I wanted to take this trade right here to trade from yellow to something, and I bought it yellow to something, what the best part of this is I can use this to put my stop somewhere. I can know that if price somehow, by some magical reason or some catalyst or some unusual selling, starts to break through the level where there is no liquidity, where there is no arrow, no liquidity, then I'm just going to stop out of my trade when it breaks through the level where there is no liquidity. I don't want to be long the market when it falls to an illiquid spot. So now what we have here at Rocket Scooter is the world's first algorithmic risk management platform for retail traders, that I can know that no matter what I do, if I want to long or I want to short the market, I can look and say, well, all forces are long from here. Why would I want to be the only person long below that? So now I can make some reward. And this is another calculation. I can look for how far I want the market to travel to versus where my risk is and where I cut my trade. So now with this algorithmic risk management type process, I can actually just look and see where the market has illiquid spots and put my stop loss where the market's not supposed to go. And if the market goes there, you can say, well, why did it go there? I don't care. It shouldn't have gone there. Some extra factor that I can't pierce the veil and see who sold and why. Everybody's motivated by a million different reasons. Where technical analysis fails, it'll try to guess and tell you, well, people are all selling there because these two lines crossed over. That sounds ridiculous. No, somebody decided to sell because they came to their office. There's a sticky note on their monitor and their boss says, hey, sell the Apple before 3:00. We need to get out of this position. And then they just sell, or Eli or Lily, whatever. Let's just sell everything. And they just push the button to sell. Well, you can have forecasted that. And maybe they sold just enough to tip the scale over. But the idea is that you know where the scale tips over. And I don't want to be trading against unusual forces in the market. You hear all this unusual flow and unusual this and that. I'm going to tell you where the unusual activity takes place before they're going to tell you the unusual activity is happening. I'm going to give you the level where you'll see that unusual activity pop right up. So what I do here is I'll type in a ticker. I will look at the risk distribution and I can come in and I can look and see what I'm expecting to happen. And more importantly, what shouldn't be happening under normal non-catalytic situations. Apart from being kind of the focus of positional risk, where the distribution of market maker risk, or the hedging, we have a lot of other indicators here that also look at the market completely differently than technical analysis has. All of our indicators are designed to be forward looking. None of them take past historic price data and look into the future. This is a program designed by engineers who decided that the current status quo of what's being taught in retail trading is very weak and very outdated. And ever since the market became computerized and decimalized in the early 2000s, that the old techniques of staring at patterns and Fibonacci's and things like that, they just do not work in the modern day. And they barely worked when they were invented as is. And it's time for something new. And hopefully we can bring something new to you. So you guys take a look. We live stream every day. We have a full educational series of videos, resources, training, an algorithmic platform that gives you these levels on your charts every single day. It's nice and simple display, so you don't have a lot really kind of cluttering up your charts, and you see I have no indicators on top of the charts. So just to kind of go through a couple more things really quick while you're taking a look at this, I'm going to load up SPY, which we started off the video showing. Now, again, SPY has a little distribution of risk: bear, short, and down. The opposite of the one we just showed. So SPY has everything pointing down instead of LLY, which is everything pointing up. And as you see, when I look at SPY, you kind of show this right here. If I pull up the playbook once again, and this is available in our Discord, SPY BRSD is this one I'm circling at the bottom. Let me kind of get my right here. So we open right here. It shows me that from the open, I'm looking for a bounce against blue and a return to open. Blue is here. A bounce against blue and return to open. You can see it right here. That little tiny upside down V is this guy right here. Let's scratch it off because it already took place. Now, yellow and blue are at the same spot this time, so there isn't a trade between the two. But I'm still going to have the same kind of analysis, right? I'm going to expect the market to hit yellow and reject. Now, there's a little bit of overshoot, so we always give everything at least a one strike stop distance above the other side. So, you know, clearly the market is looking to reject, and for a slight bit of time, it broke through, but that's a false breakout. And we have another indicator that can help you see that. I'll walk through those just very quickly. So right now I have that kind of rejection off of yellow, which is that general direction you're looking to see. And even so, I have another indicator that goes with that, which is called resilience, which we showed earlier in the day, which can actually look at what the stocks are doing before what the index is doing. So let me clear all this really quick. And that with resilience is really neat because while I do have this signal pushing down, which is what the algorithm showed me to expect, for a slight bit of time, this little yellow line pops above 0. And all that means is that wherever you are on the S&P, while this is going on, the S&P wants to be above its yellow line. So this comes in on top of this to invalidate certain setups that I wouldn't want to take. Like if I wanted to short against there, and while we're tapping it, this is above 0. This tells me don't short against it yet. I don't want to. So I'm looking at this because the sum of the stocks are actually breaking through those hedging levels faster than the index is pricing in those values. So it kind of leads the indicator. The indicator leads the market just a little bit. In this instance, right about here is when we got that signal that the stocks are pushing through. We had some big cap stocks push through. We had Apple, Microsoft, Google all push through today. And all of a sudden, as the index is actually trailing down, our signal's pushing up. So it's actually showing that arbitrage opportunity. Now, another layer to this is half gap resilience, which is another tool we have, which is this white line. If this white line is below 0, then white is resistance. So at this moment in time, white is resistance, yellow is support. You can see that the market is showing just that. Yellow is support, white is resistance. So had I bought the long, I knew that I was going to end my trade at the white. So I trade right to the white and close out for profit. As the market starts to trade back down, that playbook is back to being active. And now I'm watching the market sit here and say, well, that should still be support, but this should be resistance, right? So I'm not necessarily looking for the market to break through and rally until this white line goes above 0 as well. So you can see how I'm looking at the way that the stocks are being bought and sold themselves to know where the index is supposed to be priced. These are just other indicators that go with it. We have 12 total. I just went over 5 of them. So we invite you guys to come check out our stream, check out our educational material, check out our free Discord, click the link here on the page, and you'll see everything we have to offer. And just come by, send me a message. We'd love to show you guys what we have. And we're really glad to be out here engineering new solutions for traders in the modern day. So thanks for tuning in.